Hello everyone, this is chapter 2 and we will go through the balance sheet. Alright, what is a balance sheet? A balance sheet is a snapshot of the financial picture of the company at a specific point in time, right? So what are the keywords here? Snapshot, financial picture at a given point in time. That's why when you're looking at a balance sheet, point in time. Right? That's why when you look at a balance sheet and you look at the very top, you'll see a specific date. It's either on December 31st of 2017. That means that the numbers you're looking at and the categories, the line items that you're looking at is for that specific point. It's for that specific date, December 31st of 2017 in my example. So what are the main categories of a balance sheet? You have your assets on one side, right? And you have your liability, and your equities, right? So you have your assets on the left side, liabilities and equity on the right side, right? So within the asset, you have your current assets and your non-current assets. And on your liabilities, you have your current liabilities and your non-current liabilities. And equities, you have your owner's equity. You have your retained earnings. And then you have if the company issues any stocks, that's where you'll find the stocks issued. All right. Excuse my handwriting. So let's go back and talk a little bit about the assets. Give me some time to erase all of that. All right. Let's talk about the assets for a minute. So there are two sections within the assets within a balance sheet. Okay, so current assets. All right, current assets. This is where you'll find the cash, right? After the cash, you will find your accounts receivable, and then you'll find your inventory. And last but not least, you'll find any prepaid expenses. All right. So the current assets are listed in that way. It's listed in the order of liquidity, right? So what is liquidity? Liquidity is an asset that we can quickly converted into cash or cash-like items without losing any significant values, right? So cash is cash. That's the most liquid. Your accounts receivable, right? You can recuperate that money in the very fast period of time, usually 30 days or 60 days. Your inventory is the third item on the current assets. Now, inventory, you can convert that into cash in a very fast period, but you have to remember you will lose some value, right? If you decide to raise some money by liquidating your inventory, you will have to do what's called a fire sale. Therefore, you'll have to sell things at a discount. 20, 30, 40%, depending on how fast you want to bring that cash in. And your prepaid expenses is simply a sum paid in advance. So if you pay your rent in advance, if you purchase something in advance or service in advance and you pay in full, that will be considered a prepaid expense. All right. So your cash is available at any time. Your accounts receivable is money to be received from customers in a future date. Your inventory is a list of goods to be sold, and your prepaid expenses is the sum paid in advance. All right. So these are your current assets. All right. Now, at the bottom of your assets, you will find what's called your non-current assets. Right. Your non-current assets. Let me write it down. Non-current assets are things like your long-term asset. Okay, and these are your plants. These are your equipment. These are your furnitures, and your buildings. Okay, so these are assets that are on your balance sheet for years, right? These are investments you make to grow your company. If you build a new buildings, if you buy a new piece of equipment, if you buy furnitures, these are things that will sit on your company, on your asset side for a period of more than a year. So your current assets are there for a year or less, and your non-current assets will hold a value for more than a year. All right. So this is these are your assets. The next category we'll review is your liability. All right. What is a liability? A liability is something, money owed to somebody else, right? It's either a current liability, right? You have your current liabilities, right? You have your accounts payable. You have your accrued expense. And then you have your non-current liability, which is your long-term debt. All right. So what is your accounts payable? Your accounts payable is money not yet paid, right? If you purchase something from a vendor and you have 30 days, 45 days or 60 days to pay, then that amount of money will sit in your accounts payable. So it is sum of money not yet paid. Okay. Accrued expense could be anything from payroll, right, or taxes. Okay, so you know your payroll, you make your payroll maybe twice a month on the 1st and the 15th, or once a month on the 30th. That payroll will accrue until you make that payment. And where do you find that amount of money that's been accruing during the period before you pay? It'll sit on your liability side because that's money owed to somebody else. And more specifically, it'll sit in your accrued expense. All right. Same thing for taxes. You pay taxes at the end of the year. Maybe you pay quarterly. Maybe you pay twice a year. Most companies will pay once a year when taxes are due. How do you know how much is due at any specific point in time? Because that's what the balance sheet is. The balance sheet is a financial picture of the company at a specific point in time. If you want to know how much taxes you owe as of September 15th of 2017, you will go into your balance sheet, you will check your liability, go into your accrued expense, and you'll be able to know exactly how much money is sitting in that account. Okay? Non-current asset, these are your long-term debt. These are payments to be made. These are sum of money owed over a longer period of time, maybe more than a year. Some long-term debt will be for 5 years, 10 years, 15 years, 30 years, depending on the structure of the debt. All right, so that covers your liability. Last but not least, you have your equity. Okay. Give me a second here to erase all of that. Last portion of your balance sheet is your equity. Now, on this section, you have your owner's equity. You have your retained earnings. And you have stocks. I'll put it there because if it's a public company and you issue some stocks, this is where you'll find the value of the stocks that you issued. Okay. So that being said, I want to talk a little bit about the equation of the balance sheet and why that equation is so important for you guys to understand everything that I've just said thus far. What is the main idea to get out of that equation? I'll put it first. Asset equals liability plus equity. Asset equals to liability plus equity. In other words, the sum of your current and non-current assets must and will always equal to the sum of all your liabilities, whether it's current and non-current or long-term liabilities, and plus your equity. Okay? So every time your current asset and your non-current asset will always equal to your current liability or your long-term liability, non-current liability, plus all your equities. Okay, this is a very important equation, and you will see that every time you look at a balance sheet, it will always balance, right? The left side of the balance sheet will always equal to the right side of the balance sheet. Why? It tells you right there in the name. It must balance why? Because it's a balance sheet, right? If you understand that concept, then you'll always be able to make sure that you keep your balance sheet balanced, right? So I'll explain another way for you guys to understand more. What is the relationship? I'll ask that question rather. What is the relationship between the left side of the balance sheet and the right side of the balance sheet? Well, it's simple, right? You need to have assets to generate money, right? And this money will be used to pay your liabilities and return money to the equity holders, right? Liabilities. Why do you have liabilities? Because you owe money to some people. Maybe you went to the bank to borrow some money in order to purchase that asset. Maybe you needed $100 to purchase that piece of equipment to run the company. Okay, so you need $100 to purchase that piece of equipment. You go to the bank says, I can only let you borrow $50. You go back to some friends or some investors and they're able to give you the money that's left over, right? $50. Now, with the bank and, let's go back. Okay. Sorry about that. All right. Let's start over with the example. So I said that asset equals to liability plus equity. What is the relationship between the left side and the right side? You need to buy a piece of equipment that's $100 to generate some revenues so that the company can be profitable. You need $100 to purchase that piece of asset. You go to the bank says, I can only let you borrow $50. Now you find some friends or some investors and they say, okay, no problem, John, I'll let you borrow $50. Now you have the $100 that's needed, right, to purchase that piece of equipment that is worth $100, right? Now you purchase that piece of equipment. Now that piece of equipment needs to generate enough income to pay the bank and also to pay the investors that have that lended you some money. All right. So the relationship between the left side and the right side, the reason why they have to balance is you need $100 to purchase that piece of equipment. You got $50 from the banks. You have $50 from your investors. Therefore, 50 plus 50 is balanced. You have your $100 and you purchase that piece of equipment in order to generate revenues. And that revenue will be used to pay back interest and principal on the money you borrowed from the bank, and it'll be used to pay the investors. Maybe they're asking you for dividends on a yearly basis until you return that $50. So that's the reason why your asset always equals to your liability plus your equity. And you always have to remember that when you're looking at your financial statements, most likely when you're looking at the balance sheet. Asset equals to liability plus equity. Asset equals to liability plus equity. Okay, what are assets? Assets is something that will give you a future economic benefit, right? Economic benefit. Your asset is something that will give you a future economic benefit. Your liability is an economic obligation to someone else. It's an IOU. All right. Your liabilities are an economic obligation to someone else. It's an IOU. That's all it is. All right. And also your equity, that's where all the money that's invested that is not a liability, it will sit in your equity. Okay. And that is all for your